Rakesh Arora, Head of Research and Managing Director with Macquarie Capital Services.
Rakesh, what according to you was so disappointing for the market? And do you think one big factor was the fact that the finance minister did nothing to prop up growth? Yes, he maintained the fiscal deficit target, did not indicate anything on the math, because when an FII puts money into India, he's buying 15 times for growth, and there was nothing mentioned on that.
On the contrary, I think this budget was full of growth because expenditures, as we maintained at 30% growth. See, 2 weeks back, everybody was worried that, finance minister is cutting expenditure and, that will have a impact on the growth, both in consumption, investments. And now when he has maintained expenditure at 30%, people are saying, oh, the quality of budget is not that great. So I think by maintaining expenditure, it was pro-growth. Number two, he has done three important things. One is, as Rahul mentioned, 15% investment allowance for companies doing capex in FY14 and FY15. I mean, speaking to corporates, a lot of them are really excited about this because this alone can add around 2.5% to IRR of the companies and actually shaves off 5% from the project cost immediately. So it's a big positive, and I will not be surprised if capex really picks up dramatically in the next 2 years as people and corporates move in to take advantage. Number three is that he has earmarked funds for 3,000 kilometers of road to be awarded in the next 6 months. So there were concerns about private companies being able to finance roads under private participation. So by government moving in and earmarking budgetary support, I think that gives us a lot of surety on that big infrastructure space. And finally, he has raised that limit to 50,000 crore for tax-free bonds, so which should also give leeway for NHAI, railways, power ministry, etc., to raise funds. So overall, I think maybe this issue was not really highlighted yesterday because of the focus on the 90A rule, etc. But I think this budget is excellent in terms of pushing the growth, and we should see results coming through in the next few months.
Rakesh, so what explains the disappointment by the market yesterday, or would you say this was just futures and options settlement related?
Yeah, I mean, a combination of a lot of factors. What finance minister said was actually very well known. So people are looking for something new, and when you ask them what new, meaning they have no answer. So it is just that they wanted some miracle to happen, which didn't really happen. But I think it was a kind of a reaction, impulsive reaction, and we had a lot of long position expiry days. So it all accumulated into a sharper than expected reaction. But I think market should recover today, and we should be back on track.
I'm sure you must have interacted with some of your clients who come to the Mauritius route. Are they worried about something?
Well, see, we haven't really got any nervous calls from the investors. I mean, it's not like what happened during the GAR thing. Most people do believe that the finance minister is very supportive of high inflows. So there's hardly anything which anybody is expecting in terms of any adverse, policies to come in. And he's already, categorically said that if there's something, he will look into it. So I think yesterday was a, unusual reaction, but as people have heard the finance minister in the evening in the media conference, etc., I think that should have soothed all the nerves on this aspect at least. And finally, those guys, meaning taxation is getting tight everywhere in the world. It is not just India. I mean, all governments are looking to increase tax base. So leakages are going to be stopped. If not in our country, then other countries. So investors have to get prepared.
Every finance minister wants to increase and protect the tax base because global growth is not that strong. So, there is no problem with that. So, Rakesh, I don't want to get this one wrong. What you are mentioning is rather important. What you are mentioning is that the Mauritius tax issue is not a big problem, and markets are likely to just, ignore that point going forward.
That's exactly what I'm saying, yes.
Rakesh, what explains the selling that we saw in banks? So would you say that was pretty much across the board, so banks wouldn't be left behind either?
I mean, there was hardly anything specific for the banks to, really fall that much. Obviously, it was, I think, some expectation was built in, and, the long positions got cut yesterday. But, we remain confident that, banks is the sector to play, because if we are confident of India's economy recovering in the next year or two, GDP growth moving up to around 7% in 2 years' time, I think banks, which is 35% of weight, has to do well. So we should take this as a buying opportunity rather than to worry too much about yesterday's fall.
Rakesh, have you done some numbers on the impact of the surcharge for the Sensex per se? After the additional surcharge, what will happen to the overall Sensex EPS?
Well, Nikhil, that is difficult to calculate because it will all depend on how capex is done by these companies. Maybe there's a chance that if they do capex, then probably they can show a much lower tax rate than what they're paying even now. Otherwise, it is a 1.5% hit on the earnings growth for next year. Since it is, told to be one-off for 1 year, I don't think it will impact the NPV levels or DCFs that we do for most companies as much, So not a major impact, and will depend on, capex program for individual companies.
So to your mind, based on Union Budget 2013, which are clear winners and which are clear losers?
Clearly, see, the focus is on investment, infrastructure, growth. So the companies which are levered to these space are actually banks and industrials. So they are some of the stocks one should look at, probably L&T, SBI, Axis Bank. These are top 3 ideas that we are pushing from our house.
Rakesh, do you think the year could pan out pretty crucial for the energy space? I mean, the finance minister has talked about a gas pricing policy review. He's also talked about shale gas exploration, which is going to be encouraged from here onwards.
Yeah, exactly. I mean, not just energy. It is a crucial year for the Indian economy. I think this is reform number 3. We had big reforms in 1991. Which moved India away from that Hindu growth rate to around 6.5–7%. Then we had reforms in 2000, 2002, all the power sector deregulation and those gold quadrilateral, etc. coming through, which pushed growth back to 9%. And I think the current reforms we are seeing is definitely going to push India back to around 8% plus GDP growth in 3 to 4 years' time. So not just oil and gas, it's all sectors which are getting impacted, and I think this is the time to really buy India from a long-term perspective. And FIs are already loading up. The FI holding has already touched 18% of the total shareholding for the top 200 companies. I think domestics has to really join in now for to take part into this big inflection point that we are seeing in Indian growth.
Now, you mentioned that the planned expenditure spent for FY14 is reasonable. It's about 30%. So that's a good number. But the problem with such a fat planned expenditure number is that it will also stroke inflation. So do you think for next financial year, which is FY14, the biggest risk actually could be inflation once again?
See, I think the expenditure is largely into areas of investment. So maybe like 3,000 kilometers of road being built. The other provisions that he has made on GST, etc. These are all, capital expenditure, and should really help mitigate inflation. Now, take the example of food security bill. He has earmarked 10,000 crores for that. Now, the first phase is actually building in warehouses, distribution network, which should actually lower the cost of, food supplies. So, I don't see a major problem, coming up because of inflation. I mean, we are actually fighting growth at the moment, and inflation is already surprising on the positive side. I mean, nobody expected it to be 6.5% in the last reading. So I won't really worry too much about inflation at the moment. I think the focus has to shift to growth, and that is where government priorities lie at the moment.
Rakesh, the bond yield are sub 8%. In fact, after the budget, the bond yields have come down marginally. So do you think secretly bond markets are now pricing in a rate cut? Because Reserve Bank of India has always maintained that for them to consider a rate cut, they need a strong fiscal deficit number in place. Finance Minister has committed to 4.8% fiscal deficit, which is a strong number. So do you think we are in for a strong rate cut or a strong policy action from RBI now?
See, I don't think we are expecting a very strong action. Probably on 19 March when RBI meets, probably we are expecting 25 basis point cut. So it's not a really strong one, and it will take some time before the transmission happens, because the government borrowing program actually came in slightly higher than what people are expecting, and that what really spooked the bond market yesterday. And I think it will take a lot more interest rate cuts before market can actually move in. So my personal belief is that while interest rate cuts are required, maybe the current governor may not really press the button, and probably it will be up to the next governor who comes in after September to push through these interest rate cuts in a much bigger way.
Rakesh, what about some of the consumer sector names, the likes of an ITC? I mean, yeah, the excess duty has been, held out to about almost 18%. But do you think this, like it happens every year, is just going to be passed on to the consumers?
I mean, they already passed on probably, and that is the reason. It's a classic trade, sell before budget and buy around budget. So that's what is really playing out. It's not really a game changer.
Rakesh, do you like anything from the wreck of the mid and the small cap space? Because that space has got corrected. If I look at the P multiple for the mid cap index, the P multiple for the mid cap index for the first time in many months has gone below its historic average.
See, we do have our favorites. Among the mid caps, we are pushing Aisha Motor in autos, Vocard in pharma, Dish TV in media. So in IT, Hexaware. So we have our preferences among these names. But what I was saying is that from investor perspective, I think large caps will move up first before people go back to mid caps. So I think investors should look to invest more in large caps at the moment than mid caps. Probably wait for things to settle down a little bit and then get into all these names.
Rakesh, we've seen how earnings have panned out in the quarter gone by, and it hasn't been an impressive third quarter. What, according to you, is going to see sectorally instilled growth from here onwards?
In the third quarter, largely EBITDA margins held up pretty well, and revenue growth was disappointing at around 9% or so. And while the net profit growth didn't really inspire much, but if you took out 3-4 companies, like Tata Motors, Tata Steel, Dr. Reddy's, Bharti, I mean the growth was okay at around 9-10%, which wasn't as expected. So largely you will see that these companies that I mentioned are ones which have predominant foreign operations, and they were impacted because of that. Now going forward, all this expenditure growth that we are talking about from government plus investment cycle, and also the potential interest rate cuts, this should boost revenue growth back to around 14-15%, and that is what is the real driver. I mean, market is expecting around 12-13% growth in earnings for FY14, and we think that if interest rate cuts etc. pick up meaningfully, probably we can overdo this number quite easily. So from the earnings point of view, I would say that when I look at earnings revisions, which is upgrade versus downgrade, now upgrades are actually equaling downgrades. So we are not really seeing too much of downgrades come through from these levels. So there's already too much of pessimism built into consensus estimate. And I think a little bit of positive can really trigger an upgrade cycle from here on.
Right. Rakesh, so if somebody is keen to understand the next 6-month market movement, do you think for next 6 months Indian markets are not headed anywhere because the benefits of the expenditure or the benefits of the budget will only kick in after 6 months, and one side consumers are slowing down? So for next 3 to 6 months, do you think Indian markets are stuck in a range?
It will depend on two things. One is how fast the interest rate cuts are happening. And the other is how the monsoon really plays out, meaning from May, June, you will start talking about it. So if these two things are favorable, probably we can get a strong rally even in the next 6-month period. But one thing is very clear, that markets are looking totally bottomed out. It is just the speed of recovery which is under question. So I would say that, buying on dips is the call, meaning people have to accumulate stocks on dips. And hopefully, monsoon and interest rate would play the trigger. Otherwise, we are into a secular bull run from a 2 to 3 year perspective. So chances of making money in a 1 year, 2 year is much more higher. Probably a little bit doubtful in 3 month, 6 month period.
Okay, Rakesh, on that bullish note, we will let you go. Appreciate you taking the time out and joining us.